Some of our guests commenting on the virus impact to U.S. jobs. And joining us now for more on those job numbers is Caravel Concepts Chairman and CEO Michael Jones. Michael, walk me through why the market rallied today. I know that markets really do not like uncertainty. So despite the fact that those jobless claims were 6 million this week after 3 million last week, which brings us to almost 10 million in 2 weeks alone, is it at least happy for the markets that they're getting some clarity over the real numbers? They can really now start to quantify the economic damage that's going on?
I think the market got reassurance on 2 points today. First of all, as you noted, the jobless claims numbers were 2 times what investors were expecting. We also should note that tragically COVID-19 infections were also worse than investors were expecting. And yet the market was able to hold key support at 2,400 on the S&P 500. Now contrast that with 2 weeks ago when we got news that was far less onerous and we punched right through that key support level. The fact that we were able to hold it today suggests that the combination of the $2 trillion stimulus plan, the president's more somber and realistic tone on the seriousness of this pandemic, I think investors are feeling more confident about the future outlook, and they're willing to look through bad news and bid up stocks in the face of bad news.
Is MMT here, no matter if we're ready for it or not?
Yeah, this is, I think, the other thing that investors are starting to get their heads around, and they're recognizing that it is a new era in the U.S. economy. The $2 trillion stimulus package can only be financed by the Fed cranking up its balance sheet and printing another few $1 trillion over the next 12 months. That means that whether they say it or not, the President, Congress, and Fed Chairman Powell have joined AOC and her compatriots on the far left by embracing modern monetary theory, the notion that endless stimulus spending can be financed by printing the money, provided that the inflation rate stays low. What that essentially does is it gives an unlimited checkbook to Congress and the president to stimulate the economy. They've made it clear they'll spend whatever it takes to get this economy back on its feet. The Fed has made it clear they will print whatever it takes to finance that spending, and I think you're foolish to bet against them. They don't fight the Fed. When the Fed is willing to finance endless stimulus spending, ultimately that stimulus spending will be effective and the economy is going to recover. Then the markets will have to deal with the extra $3 trillion floating in the system.
Yeah, Michael, that's my next point. With this great big rolling ball of money, we are just setting up for the mother of all asset bubbles?
Well, let's remember that bubbles are fun to ride on the way up, but we should note, go back. I think what the President, Congress, and Fed Chairman Powell are drawing comfort from is everybody expected bubbles and inflation 12 years ago during the financial crisis when the Fed printed a lot of money. It didn't happen, so now they're very reassured that it will never happen. Well, actually, 12 years ago, as much as the Fed was printing, the shadow bank was collapsing, the shadow bank system, and it was unprinting a lot of what the Fed was shoving into the economy. That is not going to happen now. We are explicitly forbidding foreclosures and the other kinds of things that would cause a contraction in private credit. So the whole $3 trillion the Fed's going to print is going to wind up in financial markets. I think it creates a real prospect for too much money chasing too few assets, and I think that will be fun as the bubble inflates. You just need an exit strategy.
So you see support for the S&P at around 2,100. What do you do as an investor at the moment? Because there's increasingly people who are sidelining themselves, holding more in cash. Cash is king. Just because there is a market doesn't mean you have to invest in it. What's the right balance of being opportunistic but frightened, I guess?
Yeah, well, look, can the market break through 2,400? Absolutely. We are going to get so much bad news over the next 2 to 4 weeks that, 2,400 is the first support, but we've already broken that once. Could we break it again? Absolutely. 2100 is critical support because that was resistance all through 2015 and 2016. We just couldn't get through it on the way up. It's going to be very powerful support on the way down. I would be very shocked with all the money and all the stimulus being thrown at the economy if we broke 2100. So if I think what investors ought to be thinking about, and what I'm personally doing in our portfolios, is I'm thinking about what's happening 12, 18, 24 months out. And I think with all this stimulus money, with $3 trillion that's going to be pushed into the economy, that's a lot of money that's going to be looking for a home. And I think that if you can take that longer view, there's a lot of support for equity prices once we get through what will undoubtedly be an awful lot of bad news.
Yeah.
And look at your alternatives. Bonds yield next to nothing. So it feels like when everything else looks ridiculously expensive, then stocks must be relatively cheap, and I think they are. And I think in a world of modern monetary theory, you want assets where their cash flows, their earnings can scale with the amount of money that's being injected into the economy, and that means equities.
Michael, I want to fold that over, though, into the concept that smart money is in bonds. If that's the case, investors just put in a record $7 billion of inflows into U.S. high-grade bond funds, high-yield bond funds this week. Does that tell you that the worst is over?
I think normally credit spreads start tightening before equities get serious about rallying. So I agree with your assessment of bond investors. As those credit spreads, and particularly on high yield, we should recognize there is going to be a default cycle in high yield. And I would say, if you look at the amount, typically there's 8 to 10 years between big default cycles because we clean out the weak companies and then we overlend to them after about 8 to 10 years, and there's more weak companies to clean out. We have a very large pile of weak companies that are going to have to be cleaned out of the high-yield pool, and defaults will probably hit 10% over the next 12 to 18 months. Having said that, that is well priced in right now, given what historical recovery rates have been. And as you note, smart money is starting to sniff a bargain. High-yield turns, investment-grade turns, then equities turn. I think you're exactly right in terms of what that signals for the future for equity investors.
Our thank you there to Caravel Concepts Chairman and CEO Michael Jones. Not in the high